Hello students, my name is Shesi George, your professional accounting teacher. Please, before you continue with this video, try to subscribe to my YouTube channel. In this video, we are going to look at the concept of absorption and marginal costing principle by using this question as a case study. All right. Now, before you answer a question on absorption costing and marginal costing, first read the requirements. The requirement says that you are required to prepare a profit statement for the month. Profit statement for the month of July using absorption costing principle and B, marginal costing principle. That's the first thing you check. So we are to use this principle to prepare a profit statement, not to calculate the cost of products. Sometimes you may be asked to use it to calculate the cost of products. Okay. Now, to do this, there are two working notes to be done. There are two working notes. These are the working notes. Number one, we have the calculation of overhead absorption rates. Calculation of overhead absorption rates. Then the preparation of standard cost card. Now, to calculate the overhead absorption rate, you have overhead equals to budgeted overhead all over budgeted level of activity. What you should check is that the budgeted overhead must be in the same base with the budgeted level of activity. What do I mean? If you are giving budgeted overhead per annum, you must make sure that the budgeted level of activity is also per annum. So students should take note of that. If it is monthly, make sure that this is also monthly, just to test whether you are smart. All right. Then preparation of standard cost card. Standard cost card means the statement showing the costs per unit, the production costs of product per unit. Okay, and that is direct material, direct labor, variable production overhead. We have the marginal cost. All right. Then we have fixed overhead, fixed production overhead absorbed. Take note of that. Then we have full cost of production per unit. Full cost of production per unit. Are you with me? Then we have the standard margin, which is the profit. Then we have the selling price. So this is a format for calculating cost per unit by the preparation of a standard cost card of the company. Now let's go to the main question. All right. Now the main question says profit statement. So you are going to start with Sabe. Are you with me? So we have Sabe. That's the name of the business. You write Sabe Limited. So you have profit statement for month of July using absorption costing principle. So as a way of standard, I will always start with my level of activities. That's level of activity we have in units. So we have our opening inventory. Start with your opening inventory. Okay. From the question, we are not giving the opening inventory. We are only giving the production unit. So just put dash here. Then we have the production units. The production unit is being given. All right. The production units is 30,000 units. That's 30,000 units. We have the sales units, which is sales is 28,000 units. Okay. Then when you subtract this will give you your closing inventory. Closing inventory. And that is 2,000 units. Okay, class. Now, like I said, that you will start with the two calculations. But since you have been given the standard cost card of the company, the standard cost card of the company has been given. So these two calculations that I mentioned earlier is immaterial concerning this question. It's not needed. All right. It is when you are not giving the standard cost card, that's when you prepare the standard cost card, and you are not giving the absorption rates. Okay. So you have been giving all the rates, absorption rate, production, for production, variable production overhead, you have been given for this. So there is no need of calculating the two working notes before the main question. So you have been given this, then you have been given the actual, that's the production and sales quantity for the month is also given. Then the fixed production overhead has been computed on the basis of budgeted normal level of what? Output. All right, so when we get here, I'm going to tell you what to do. Now, let us start with our preparation. So you have two columns. You can have your two columns here. Okay, you start with your sales. And what is selling price per unit from the standard cost card? The selling price per unit is 45 naira. So you have 45 naira. 45 naira multiplied by the sales unit, which is 28,000 units. That's 28,000 units. And this will give you, when you press your calculator, 1,260,000. 1,260,000, okay? Then you say less full costs of production. Less full cost of what? Production. Why? Because we are using absorption costing. Absorption costing considered all the costs, both variable and fixed. It's a technique that consider both variable and fixed, all right, into the cost of the products. All right, now we have opening inventory. So I'm giving you a standard format, opening inventory, but in our question it's not given, but for a way of format, then this is at the full cost, and that full cost, how much is our full cost here? Is 31 naira per unit from the standard cost card. Do you get it? But the question has prepared it for us, so it's at 31 naira. But since this is zero, we don't have it in the question, it's not given, this will be nil. Okay, let's put dash. Then the next thing is direct material. So the direct material per unit, is 12 naira. The labor is 8 naira. The variable production overhead is 3 naira. So you now say 12 naira for direct material multiplied by the production unit. What is our production unit? Is 30,000 units. 30,000 units. Okay. So which is 30,000 units, and that will give you, when you multiply, I think 360,000. Then we have direct labor is 8 naira times production unit 30,000, and that will give you 240,000. Then we have a variable production overheads, and that will give us 3 naira from the cost card. It's 3 naira from the cost card, as you can see. 3 naira. These two have been done from the cost card, which is times 30,000, and that will give you 90,000. 90,000. Okay. Then fixed production overhead is also giving, which is 8 naira. That is fixed production overhead. Absorption rate is 8 naira. So we have 8 naira times 30,000, and that will give us 240 also. Then you add this total. So when you add this from your calculator, you have 930,000. 930,000, then you say less. So closing inventory. Don't forget, at 31 naira. So what is our closing inventory, class? The closing inventory is 31 naira multiplied by 2,000 units. Okay, 2,000 units closing inventory. You produce 30,000 units, you sold 28, so the remaining leftover is 2,000. Then you now multiply by that figure, and this will give you, when you multiply, it will give you, from your calculator, we have 62,000. Then this will give you costs, full costs of goods sold. Cost of goods sold. Our cost of goods sold, how much is that? That is 8. When you subtract this, we have 868,000. So when you subtract 390,000 from, if you subtract 62,000 from 390,000, it will give you 8. So that's our cost of goods sold. Okay. Now, if you subtract the cost of goods sold from your sales, if you subtract the cost of goods sold from your sales, what do you have? You have your gross profits, and that will give us 39200. Don't forget, you need to adjust for this gross profit. So we have adjustments for over or under absorbed. Okay, over or under absorbed. Now, before we go further, let me give you this concept. What is absorbed overhead? Don't forget, absorbed overhead is OAR times actual. So OAR times actual level of activity. All right. Now, to calculate over or under absorbed, you have absorbed overheads less, that's minus actual or normal overhead. Actual, these are the terms questions normally use. Okay, so go by this format, please. You go by this format. You start with absorbed, then you say minus actual. Don't forget in the exam. If your answer is positive, it is called over. If your answer is negative, it is called under absorbed. Are you with me? Under absorbed. Okay, it's just like you have charged 100 naira and you are supposed, the normal something is 80 naira. It means you have overcharged. That is 100 naira, but the actual is 80 naira. So you have to 20 naira, which is overcharged. Absorb means to charge, to reduce your profits. Are you with me? It means you have over reduced the profit, because the more the profits, the more the expenses, the lesser your profits. Okay, the lesser your profit. But if it is under absorbed, let's say it's 100 naira, then you have under absorbed. Then the actual is what? Let's say 150. Okay, the actual is 150. So you are going to get a negative of 50. So it means this is what you absorbed into the product. This is what you charge into the product. But this is the actual thing that's happened, or that's supposed to happen. Are you with me? It means you have undercharged. So you need to subtract this from the gross profit to get the adjusted profit. You need to add the over. So we normally add over, you subtract under. All right. Are you with me now? Okay. So from this question, look at our absorbed overheads. Our absorbed overhead is 240. Okay. Our absorbed overhead is 240. So we have workings here. You can just work in note 1. Calculation of over or under absorbed. Okay, so our absorbed overheads, our absorbed overhead from that question is 240. Okay, then our actual overhead or normal overhead, our normal overhead, we are told that, look at from the question, what were you told? We are told that fixed production overhead had been computed on the basis of projected normal level of activity. Are you with me? Which is 389. Are you with me? So the normal overhead, this one, don't forget, this one is per annum. So you have to reduce it by, you have to divide it by 12, because our statement is based on monthly. this is a monthly statement. So what you will do, you now say that's 8 naira multiplied by 381,000 all over 12. Okay, because we have used 8 naira multiplied by 30,000 here, which is for the month of July. So you have to, divide this by 12 to get per month. So when you divide this by 12, this will give us, so what do you have? That's 381,000 divided by 12. Okay, then times 8. That is 254,000. So when the actual is more than the what you absorb, we absorb 240, but we are supposed to do this. So that is under absorbed when the result is positive negative. So this is 14,000. Okay, so we now come here and say working note 1, which is 14,000 under absorbed. So under absorbed. Okay, so when you subtract, this one will now be adjusted gross profit. Adjusted gross profit. So when you subtract, what do you have as your adjusted gross profit, which is 378,000. So you now less non-production cost. So from here, these are the production costs. You less the non-production cost, and the non-production cost from this question is given. What are the non-production costs? We are told that fixed overhead are equal throughout the year evenly. The selling, distribution, and administration overhead. These are the non-production costs. Okay, which is variable 10% of the sales value, fixed. So we have the non-production cost. We have selling and admin. So what do we have? We have the variable. The variable is said to be 10% multiplied by the sales, which is 126,000, and this will give you 126,000. Then the fixed selling. So don't forget, you are giving per annum. This is per annum. Are you with me? Which is 1.8 million. So it will now be 1.8. If it is per annum, and we are preparing, what are we preparing for? We are preparing for July, for a month. What will you do? You divide by 12, and that will give you 150,000. So when you add these two, what do we have? We have 276,000. Then you subtract. Then our profit for the month of July, profit for the month of July will be, when you subtract, what do you have? 102,000. So if you love this video, please share with your friends. So in the next video, we are going to look at marginal costing. Okay, marginal costing. How do we prepare marginal costing? Okay, so watch out for the next video. Thank you. Bye for now.